welcome to Simply Intoxicating on Union Budget 2017. In the background of demonetization, where the Union Finance Minister Mr. Arun Jaitley was widely advised to stick to the path of fiscal consolidation. And after looking at the fine prints of the finance bill, it appears that he has been largely guided by the fiscal prudence, and also he probably refused to play to the gallery in terms of state elections around the corner. He was under pressure from within the party to give something to the taxpayers. Of course, he has given, but he has been very selective. This time, he has been guided more by the income tax statistics. He talked about the number of Indians traveling abroad. He talked about the number of Indians driving car, jipping around in the streets, and not filing income tax return. Even if they are filing, they are underpaying it. Or probably there is a case of tax avoidance, in some cases tax evasion. So looking at the whole matrix, this time the Union Finance Minister and the NDA government, they have tailored the budget speech very carefully. They have also selected the set of taxpayers for certain benefits, which we are going to talk about with three distinguished panelists which we have. We have Mr. D.P.Sengupta, former Chief Commissioner of Income Tax, and also who had participated very actively, and he was rather the author of a couple of budgets so far as direct tax proposals are concerned. In the past, we have Mr. Sunil Chopra, the former Chief Commissioner of Income Tax. Then we have Mr. Arvind Srivastava, partner PwC. So we have three distinguished. Welcome, sir. Let me start with Mr. Chopra, sir. Please tell us something about the kind of insight which you get from on the personal income tax front from the finance bill.
Finance Minister has taken very positive measures so far as personal income tax is concerned. He didn't succumb to the temptation of increasing the exemption limit, because tax base, as he mentioned in the earlier part B of the speech, is still very small. We have about 3.7 crore people who file their returns of income. So if the exemption limit had been raised, this small taxpayer would have been further reduced. But at the same time, he has given relief to taxpayers who are having smaller incomes. For example, in the entry rate, he has reduced from the tax slab, he has reduced from 10% to 5%. It's a very, very welcome entry rate for any country. In the United States, the entry rate of tax is 15%. For people who have income up to rupees 3.5 lakhs, their tax liability has been reduced as a result of this to half, that is 2,500 rupees. Another thing which follows from reducing the entry rate of taxes, that taxpayers all over, whether they were in the 20% slab or 30% slab, they have generally got a relief of 12,500. Another very good thing which he has done is that people who are filing such returns for the first time, they will not be, their cases will not be picked up for scrutiny, except where there is specific information that they have entered into high value transactions. Even insofar as corporates are concerned, FM has done a very nice thing that those corporates, MSMEs, whose turnover is up to rupees 50 crores and who are an important factor in providing employment, their tax rate has been reduced to 25%.
While talking about this 12,500 benefit, which goes to the hand of each taxpayer, so this Section 87A rebate which has been reduced, don't you think that this will impact?
No, 87A rebate has been reduced because the tax slab has been reduced from 10% to 5%.
Right, sir.
So as a result, people having income up to 3 lakh rupees earlier were fully exempt because Section 87A relief was 5,000.
Right.
Now that has been reduced to 2,500, and their tax liability also under the proposed regime will be 2,500. So
right,
they will
sir.
not be paying any tax so far as people of incomes up to 3 lakh are concerned.
Right, sir.
So far as people of incomes up to rupees 3,50,000 are concerned, their tax liability also will be 2,500. So relief has been given to them, and I don't think there has been any. And then he has tried to compensate it by levying surcharge
Yes.
on incomes, total incomes in the case
More
of
than 50 lakhs.
individuals beyond 50 lakhs up to 1 crore
1
at
crore.
10%, and the
Right.
15% surcharge remains.
Right, correct.
And beyond that, the surcharge is
15%.
15%.
That's what I have
50%.
said just now.
Yes, sir, that's right. But so, how do you look at it, sir? You know, the FM had very little room to give away this time. Looking at the statistic where he talked about, he was churning out the statistics this time. 99 lakh taxpayers who are filing return, but absolutely within less than 2.5 lakh. Then, sir, he talked about almost 2 lakh. Sorry, 2 crore, sir, in fact. 2 crore return filers apparently falling in the category of almost 2.5 lakh to 5 lakhs. So, I mean, the major chunk of the income tax base, it goes towards this particular bracket.
And even an income, total income of 10 lakh is not very large. And people filing returns of more than 10 lakhs are just 24 lakhs in the whole country.
Absolutely. He also talked about, sir, this among the salaried taxpayers, almost 76 lakhs taxpayers who have been returning their income above 5 lakhs. So that means that looking at the tax base, sir, apparently this is, you find it very scary, sir?
We keep on saying that 1% pays tax. That's not correct. First, everybody pays tax. Everybody pays indirect tax. So when you say that only 1% of the population pays tax, that's not correct. Secondly, you will have to take it, I mean, you look at it in a proper perspective. What is the total workforce in India?
Right, so he talked about
No,
the
I'm saying these numbers. What is the total workforce? Roughly around 46 crores.
Okay, right, sir. Okay. The total chunk, yes.
You have got agricultural income which is
completely exempt. Right.
So you remove 50% of, at least 50% of the population. So right, that comes to around 22 crores or so. Then you have got a very high exemption limit of 2.5 lakhs. You tell me how many Indians are there who earn more than 2.5 lakhs per year? That comes to almost 22,000 rupees per month.
Right.
So you will not come to a figure which will be more than, let's say, 4 to 5 crores. So the ideal tax base of India will not be more than that. What is worrying is not a question of widening of tax base, it's the question of deepening of the tax base. Those who are filing income tax return, they are not perhaps declaring the appropriate income.
That's
okay.
What
so I mean so that triggers a separate debate, sir. Although I agree, sir. I mean, prima facie it appears that yes, you know, even in fact, I am familiar with good number of people who are totally dependent on agriculture. They have huge incomes. Sir. I am familiar with that. Of course, statistics speaks different stories. So maybe, I mean, how do you look at it, sir? I mean, Mr. Sengupta suggests that probably it's not widening where the focus, the eyeball should be set by the income tax department. It should be the deepening. How do you look at it?
Yeah, so the economic survey actually it says for every 100 of population, 7% are taxpayers. There was a recommendation actually being made to say that corporatized agriculture should be taxable. People doing it in an organized way should pay tax. If you see in the context of this budget, I think there's a specific provision around getting the unorganized business to pay presumptive tax at 6% without books of accounts. Probably that is a good way to bring more people into the tax net. But the way I would also like to see is, which I think every one of us have also tried to understand, is the share of direct taxes is being paid by a small proportion of people, but the share of indirect taxes is being borne by everyone without any basic exemption limit. So, which is actually a very big, it is not at all a fair system of taxation. And as we know, with going into GST, services will cost more. So I think one has to find the right balance, and so one just hopes. And one more analysis, which I kind of, it was coming out, was last 2 years the FM said tax collections have grown by 17%, and I think if you see for the next year, I think the
Yes,
revenue forecast
projected 12%.
is at 20%.
For the next year?
Yes.
Now, so far as the 17% is concerned,
Right.
this is both direct and indirect taxes.
Oh, the total, okay.
So if you see again, the buoyancy of tax revenue is expected to be even further higher. Probably some of it is expected to come
From GST.
post demonetization. Probably you will have.
Okay.
You see, globally, if you see, it's a race to the bottom. Every other country, including US, they've said they'll drop their tax rates to 15%. They want their offshore business to come onshore. They are saying that we'll have special measures to bring cash into the economy. You say UK is saying we're ready for Brexit, we'll drop our tax rates further. China is at 25%. They don't have so many slab rates. They don't probably have surcharge and cess and all of this. So we've got a much more complex system in place. So I think tax rates, the anticipation coming out from last year was all taxpayers would get relief. So last year there was a 1%, it was made 29% if you're a manufacturing company. So the anticipation and all the build up to the budget was you would see a substantial rate drop.
Corporate tax.
But while it is very fair that you give it to people who deserve, because SMEs are the future of, you had one Maruti and around them you had SMEs, and each one today they're billion-dollar companies.
Yes.
That's how you create growth. You look at Germany, you look at other countries, they've always focused on SMEs. But taxes alone are not incentive enough. How do you get them credit? How do you give them access to international markets? How do you revive exports? A lot of things are important. But having said that, large taxpayers, those who earn more than 50 crores of revenues, over 10 crores of profits, there was a statistic again being made. Only 7,500 companies in India who earn profits over 10 crores.
10 crore, right.
That's again a very compelling statistic. And out of 7,500, you would probably assume 50-60% are FDI finance companies.
Yes.
So we have to bear in mind that we need to attract, and our trade deficit is compensated by capital inflow. So we need to have FDI, while on one hand there's a mention about FIPB being abolished, because that would also mean more sectors would come under the automatic route, while there's an announcement to say we've had surge in FDIs. We need to see how much of that is actually into manufacturing. A lot of FDI has come into spectrum and those kind of options. We need, the whole debate is around how many jobs are being created, how much of manufacturing is being created, is there enough thrust on high employment sectors, and what is being done for that? So can we do something sector specific? So what we've seen yesterday is probably trying to do part one, which is to look at one sector which is priority. But then, given the fact that there was wide anticipation coming out of this budget, it was felt by all of corporate India that you would have tax rates going down. Mind you, we also have a situation where many corporates today are buying assets globally because valuations are very, very cheap outside of India. Companies available for sale. And if a particular economic activity which is being done in India is moved offshore, and if those profits are being incentivized by, you could bring the cash back into India at a 15% tax rather than doing the underlying economic activity in India. It ultimately affects us because indirect taxes are not being paid, payroll taxes are not being paid, those skills are not being created in India. So we need to balance it out between companies and Indian companies going global. What would they do in a situation where tax rates are actually, in my view, they may go up? Because if you see, the depreciation rates have been reduced very quietly during the rules. Investment allowance will taper off in 18, which means if you're a company above that size and if you're heavily capex driven, your tax rates will actually go up. So which is contrary to
President Trump will help us. What he is doing, probably everything will come back to India.
Because USA perhaps is the only country which is talking of 15%. Otherwise, the corporate rates have not been that low in developing countries. And then a finance minister had given a rationale for this relief he has provided to.
Right, sir. So moving away from the corporate tax rate, so maybe in the next year perhaps he is going to grant some relief to the large corporates. Since he had limited space this time, so he offered it to MSME, which suffered more in fact. Post demonetization, if you look at this data, sir, in fact, MSMEs suffered more.
Absolutely.
And another thing is that, of course, he has mentioned it. It's a worrying thing about this tax competition that is
Right,
But if my neighbor charges a tax rate of 25%, and I charge 30%, and if industry moves out to that jurisdiction, then the job will be created there. So I reduce 25%. Then my neighbor reduces it to 20%. Then I reduce it to 20%. Then
Right.
so where are we going to settle? So I guess there is a limit up to which you can indulge in tax competition. But it is true that a lot of developed countries also, even including UK, USA is promising. I do not know how much they will actually implement that. This tax competition is a thing which one has to be very worried about. But we need tax money.
Right, correct.
Our tax GDP ratio is so low as compared to the OECD, and you build your nation on tax revenue.
So these competitions, I remember in the latest news is that the EU is planning to brand USA as a tax haven.
Yes,
so this tax competition is going down to that level.
Also, because they are I mean, it's not law, but there is something floating in the air that they will bring it to 15% or so. So there are laws of countries like Brazil which trigger CFC rules if the partner country's tax rate is less than 15%.
So while talking about these aspects, maybe sir, let me touch quickly the international taxation aspect in the budget. So I mean, what are the key proposals which you find? The finance minister last year, in fact, he implemented a couple of action plans of the OECD BEPS project. This year also he has done that. So what are the key highlights, or how this is going to impact?
The one relating to BEPS. The action 4 is relating to interest. As you know that we in India so far did not have any thin capitalization rules.
Right, sir.
And one of the ways base erosion means your money is going out of your country.
Right, sir.
So one of the ways of base erosion is charging interest.
Right, sir.
So the more you charge interest, the less the profit of the Indian entity.
Enterprise, right, sir.
And that goes out, and that interest is not charged, cannot be charged at full rate by the source country. So that's the basic issue. And one of the largest element of base erosion is interest, along with, let's say, royalty.
Right, sir.
So the OECD Action Plan 4 suggested certain limitations,
right, sir.
Of interest intra-group. I mean, with the related parties,
right,
because basically, if you get loans from a unrelated third party,
right,
pay
sir.
interest, so there is no
capping, or there is no capping. Right, sir.
So this related party interest has now been limited,
right, sir.
To a fixed percentage of EBITDA,
right, sir.
Of the company, and this is in accordance with the
BEPS recommendations.
recommendations.
So this 30%, sir, you think, sir, is good enough?
No, 30% is again the OECD report had suggested a band of 10 to 30%.
Oh, so this is the
so
the top
we have kept it at the top. Right. We could have kept it at 10,
right, sir.
But they have kept it at 30%.
30%, right, sir.
So in fact, it is quite conservative. Because the band that was suggested by the OECD was 10 to 30%.
Right, sir.
And of course, what will happen is that it's not that it is entirely lost. Also, the interest that will be disallowed then can be carried forward.
Oh, I see, sir. Okay.
For 8 years.
Oh, I see. Okay.
So, like for example, someone is with the borrowed money is investing in a long gestation project,
right,
which gives income in later years.
Okay.
So even if it is disallowed, this may later on be adjusted with the income that may arise in subsequent.
So there is a set of provision now.
Yeah.
Right, sir.
So that is, of course, it's banks and financial institutions, insurance companies are not within these purview of these,
Right.
because there is a separate work that is going on in that area. The other important area is something which is not part of the BEPS, but which relates to the transfer pricing.
Achha, right, sir.
That is a secondary adjustment. The concept has been brought in. Let me illustrate with a small example, because assuming there is an Indian company which purchases services
From associated
from a related company,
right,
let's say at 1,000.
right,
And actually later on, it is found that the arm's length price of that service should have been, let's say, 500.
right.
So you make an adjustment.
Okay.
You allow 500. That is the primary adjustment.
Right.
But what happens is that this is not in accordance with the accounting
Right.
in the books. That 500 remains available with the
Okay. With the SSC, sir.
with the associated
Right,
enterprise.
sir. Right.
So that 500 is, according to the proposal that has been mooted, that 500 will be treated as loan,
Okay.
and interest will be a notional interest. I mean, notional means, I think the arm's length interest will be charged
Right.
on that. Of course, how this will be exactly operationalized will be prescribed.
Right,
I
it
mean,
will
they
be
have
known later. Okay.
taken the power to prescribe the rules. So this is the secondary adjustment in transfer pricing. This is done by almost all OECD countries.
Maybe Silvas would like to add something to this?
Yeah, so I think two very important changes. One is on the last about secondary adjustments, what Sir just said, and also I think this limitation of interest. I think it's come as a surprise because it'll be effective in 2 months' time. So generally, when you introduce major change, you give time for industry to absorb and plan for it. So you need to have detailed guidance around it. Some countries have mechanisms to determine in advance if this arrangement is permissible. We already have anti-avoidance rules. So what would be the need when you have a GAR kind of a
Little
thing?
more time, perhaps.
Yeah,
will
you
be
could have
required.
brought it as a rule. But having said that, I think it's important. But then it does not differentiate between heavily capital-intensive industry, a service company. So I think in that sense, it's a very broad brush kind of a rule. And if you see some of our ECB regulations, they allow for very high debt to equity ratio. And even though you may be paying interest as permitted within the exchange regulations and transactions at arm's length, you would be applying withholding taxes, and you may still have a situations where the interest is at arm's length, you have withheld the right rate of tax, and you still have, it's like a double whammy. You pay tax on a transaction which is not allowable as a deduction, and in order to claim it as a deduction, you need to have profits in the future years. So if you are heavily leveraged, which we know that there was a mention about asset reconstruction companies, not many of them have found takers because it is still going through a bit of, at what value do you acquire a stressed asset.
I forgot to mention about the interest limitation. There is also a de minimis rule, because it will apply only when the interest is more than 1 crore of rupees.
Right, sir. That's important one, sir. So now, sir, we are running short of time. So maybe the closing one, so the one which you would like to highlight, sir, which we have.
I wanted to mention, even for incurring capital expenses in order to claim depreciation and Section 35AD deduction, he has again formulated the same proposal that if such expenditure in excess of rupees 10,000 is incurred, it has to be through digital method and not by cash.
Right, sir. Absolutely, yeah.
Yeah, so closing comments, if you see some other fine print coming out, you have revised time period, the revision of tax returns, you have 12 months less.
Right.
Lesser time in which assessments will be done. It will go down to 12 months from 19,
Right.
which is again welcome. If you're a taxpayer, they specifically come up with a code to say that if you've not filed your returns in time, they've prescribed penalties, a slab of penalties. So many foreign companies were not filing returns. So if you're a taxpayer, individual taxpayer, and you don't pay your returns on time, you will have to factor this. Again, it goes in with data intelligence, so you will have more of those notices coming your way. And I think 143(1)(d) has been amended, so with some safeguards, so which means refunds will come on time.
Right.
If you're a deductor of taxes, you now have a mechanism to claim interest,
Yes.
which has also found its way in the current proposals.
Right.
So I think in that sense, there's quite a bit of fine print in it, and another aspect which on house property, which is very crucial, is people who have heavily leveraged and taken home loans.
Right.
There is a restriction that you can only set off 2 lakhs
Yes.
from house property. So if
Right.
you're heavily leveraged, you have 30-40 lakhs of interest, and
Then you carry forward.
but
Yes.
being able to set it off in year 1 was a big driver.
Yeah, right. Yeah.
Big
correct.
driver for buying real estate, so
Right.
that has been amended.
One is the legacy of the Vodafone,
Right, sir.
the indirect transfer.
Right, so that's very
Even
important.
this budget has got some provision for it. There were apprehensions that if non-residents invest in FPIs
Okay.
and then they transfer the shares, whether the underlying asset being in India, they will be charged to income tax or not.
Right.
So that has been retrospectively clarified through an explanation. I suppose everybody has welcomed.
Welcome
that.
it, yes, right.
That's one thing. And another thing which is interesting, but I have not properly understood the implications of that, is that in section 90, the new explanation has been added that where a term is not defined either in the treaty.
So one has to go to the IT Act, sir.
No, well, if it is not defined in the treaty, then you will go to the IT Act.
Right, sir.
And then
If it is
not defined in
there
the
also,
IT Act, then you go to the explanation, the notification.
Okay.
So why exactly this was necessary is something I have not understood, because it was already there in the explanation that if a term is not defined in the Act or in the treaty, then
Yes, sir.
the controversy about the particularly the may be taxed
Maybe tax. Yes, sir.
implication of the word may be taxed.
So on this note, let me thank all my guests, and there are quite a few takeaways. As Mr. Sengupta rightly suggested, that globally, most of the tax jurisdictions, they have been strengthening their domestic tools, the tax tools, to tax the MNEs, and even India is on the same path. In fact, in last 2-3 years, I have seen that quite a few interesting changes with respect to OECD-based project. Some of the recommendations, India is one of the first developing countries, emerging economies to implement that. Equalization levy is one of them. Of course, this year, quite a few, the interest part, the BEPS Action Plan 4, and then the indirect tax transfer, again, that is another amendment. So quite a few, tax credit, for instance, we are likely to be a little more generous. If it is disputed, you have 6 months time, come back and avail the credit. So there's so many, on the foreign taxation aspect, changes have been done, which are being welcome. Of course, as Mr. Srivastava suggested, that this is one area where probably India will have to look at, because globally other tax jurisdictions, they have been lowering their tax base. So whether it's really going to trigger a kind of tax competition which will ultimately affect the large corporates setting up shops in India, or MNEs apparently, or maybe the Indian companies taking out, there is a lot of FDI outflow also if we look at RBI data. So looking at, because a lot of companies, the valuation cheaper, so Indian companies buying companies outside, so maybe India will have to probably resort to another set of international taxation tools in days to come, in years to come. Looking at the domestic side, that the finance minister apparently failed in honoring his own promise, the commitment for lowering the corporate tax rate. But why? Probably post demonetization, he realized that although he has been putting up a very brave face, probably there is going to be a huge shortfall. The last quarter data is yet to come up. So last quarter is going to be the most critical, which is known as the revenue drive quarter for direct tax and indirect tax both. So FM will have to probably take into account the revenue shortfall, although he has been sticking to the path of fiscal prudence. He has not relaxed that. He has not gone by the committee recommendation. He has not relaxed the fiscal deficit target, although he is talking about the revenue deficit probably being going down. So looking at all these aspects, probably he had not much room, but even then he has given a huge relief to MSME sector, probably which bore the maximum brunt of demonetization. So looking at all these aspects and the capital, virtually the entire capital gains matrix has been recast this time. A lot of relief to the real estate sector, which was in a very bad shape, perhaps because it also has a good number of semi-skilled, unskilled labor force, and we have so many youth joining this employment market virtually every year, almost 10 lakhs. So looking at all these aspects, it appears that this budget is not that bad, which most of the economists and others are looking at. Rather, the pure economists are saying that FM has done very well because he has stuck to the path of fiscal consolidation. But so far as taxpayers are concerned, some of them are very happy. A good number of them, probably the large corporates, are little unhappy this year. Probably there is something in the pipeline for the next budget, which happens to be the budget before the election year. So let's look forward to some more relief for the large corporates maybe next year. Thanking you all for watching TL Tube.